For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, welcome back. It is Managing Your Financial Future. Thanks for joining us, folks. Happy to have everybody here. Episode number 229 out of 500. I don't know how many we're going to be doing, but anyway, I just put an end to our podcast, Professor Plum. Was that a dumb idea? I shouldn't have done that.
Are you setting a retirement date for me? Is that it?
That may be, actually. You or me. I don't know. Yes, this is episode number 229 out of 505. No, this is, doesn't matter what number, but I just happened to notice that. Welcome to the podcast. This is Managing Your Financial Future. I am your podcast host, Johnny Dean. Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, is here with me. And we're talking about something that is a hot button, and this is not going to be a hot button on this show. All right, I'm going to state this right off the bat, that this budget reconciliation law that was passed here in early July, and I don't know exactly when this the date of this episode is going to drop, so things could change. But we're going to be talking about that, the big bill, and I'm going to say right off that neither Professor Plum nor I are here to endorse or oppose it. That is off the table, okay? We're not here to do that.
It is what it is.
Exactly. Good, bad. The way I see it, there's a segment of the population that it's really good for, a segment of the population that it's, somewhat good for.
Okay.
And then there's a segment that is really bad for, and there's a segment of the population that's like, it's not that great for me. And then there's a whole middle section where it's like, doesn't really do anything for me. So that's all
it did something for everybody in that it extended. And I think this is probably the most important part of this.
Yeah, let's get started on this. Yes.
It took the uncertainty out of the equation. It took the idea that our tax brackets were sunsetting and changing and going up for next year. It took that the estate tax exemption was going to get cut in half next year. All of those things are now, we don't have to worry about them. We, at least as much as tax law can be, we have some permanency to it, which makes planning a little bit more straightforward. We don't have to play what ifs as much.
Yeah, and here was the problem that at the end of 2025, the tax brackets were going to go back to pre-2017 levels. And they weren't sure. Is it going to happen? And we don't like uncertainty in planning. Well, I mean,
it's a fact of life, but at least we want to have some kind of a semblance of something we can count on.
Certainty is better.
Pre-2018. It was 2017 before pre-2018 tax levels.
You're right. Okay, pre-2017 and beyond. Do you know how long ago that was?
8 years.
Oh my gosh. Anyway, all right. So the uncertainty is probably, I don't know, it's not the biggest thing, but it's certainly.
To me, that just makes life easier to deal with.
We're
not worried about. As a planner, as somebody trying to look into the future and say, how do we make the best out of what we have today? We have at least some semblance of security. It will take an act of Congress to change these tax brackets going forward.
Well,
They're
good
not
luck
going to
then.
sunset on us.
Good luck then, is what we say. Okay, so that's one of the things that will affect most people, and certainly people listening to this podcast.
And that helps most people because it changes. Instead of going from a 10 to a 15% tax bracket, we're going to a 12%. And instead of going to a 25, we only go to a 22. And so the brackets do work out in our favor. So keeping them the same helped out almost everybody.
I gotta think so. I mean, unless you love paying taxes.
If you really do love paying taxes, you can pay more. Just pay more or over withhold. Pay your quarterlies in and don't file for a refund. You're probably not going to get a thank you for it, but whatever.
You won't.
You love paying taxes. Go ahead.
Yeah. So we're assuming most people don't. So that's good. Now to me, the other important thing, I that's all I'm going to call this. I'm just going to say that the other important part of this, the thing that really I think changed for a lot of people, is this. And I'm going to kind of combine them, but there is an increase in standard deduction, which we get every year. We generally get every year an increase in the standard deduction.
Well, and we did get one from 24 to 25. It did go up I'd have to look them up, but a couple $100, $500 per person of standard. There's a cost of living adjustment that is placed on the top of the brackets and on the standard deduction and other tax forms. Now they did change the CPI that they're using a change CPI now instead of the original CPI, which should make them increase a little faster. At least history has shown that. So what they did was they went back and retroactively applied this new way of doing it, which increased 2025's standard deduction from $15,000 to $15,750 for a single person, and from $30,000 to $31,500 for a married couple. So we all get a little bit more of a standard deduction. So if you are not itemizing, you get to offset a little bit more of your income.
And it makes for a larger 0% tax bracket that we like to call the so-called 0% tax bracket. So we have the increased standard deduction, a little bit more this year, and then we have on top of that the what do you call it? A senior deduction.
Senior deduction.
These are for
the additional senior deduction.
These
we
are
already have a little bit of a senior deduction. We've got an age 65 and older deduction that I think is $1,650 for a married couple for each person and $2,000 for a single individual. We still have those too, but this is a new one. This is on top of those.
This is
we get another deduction. Of $6,000 per person on the tax return.
This is for the really old people, the 65 and older crowd.
Oh, whatever.
All right, that's me taking a dig at Professor Plum, which I can do for the next 3 years, 3.5 years. All right, so that's a big thing, and I mean tied into that, because I think this is why they did that, has to do with the Social Security tax. So, we have a limited amount of time here, Professor Plum, but why don't we just start with the senior deduction? You just said what it was, which was per person. How does this affect people age 65 and older?
Well, typically an age 65 or older married couple had the traditional $30,000 for 2025, had the traditional $30,000 standard deduction, and another $3,200 combined $1,600 apiece of standard deduction. So they were able to offset the first $33,200 of their income and pay no taxes on it. Now you get an additional $12,000 on top of that, and so you get to offset another $12,000 of whatever income shows up on your tax return. This was kind of slated to help offset some of the tax on Social Security, figuring that most people at 65 or older have some Social Security, and so they're going to help them pay the tax by reducing their income overall. This did not change the way Social Security is, to the taxable portion of your benefits are calculated. All that stays the same. The taxable portion of your Social Security still shows up on your tax return as part of your adjusted gross income, but then you get to take this $12,000 deduction to reduce the amount of your income that's subject to overall income taxes.
Yeah.
So it does not necessarily change anything in the taxability of Social Security, but you get a bigger deduction, and most people over 65 have some Social Security, and so they're able to reduce their income by some predetermined flat amount, which has no respect with what you are actually receiving in Social Security.
So Social Security, to be absolutely clear, is still taxable. It is taxed exactly the same way as it was before. Nothing has changed with that. They did not eliminate taxes on Social Security for anybody, even people over age 65 or older. But for people who are age 65, as you said, there is I just think it offsets. I don't know what else to call it. It's an offsetting deduction.
It's a deduction to income.
Yeah.
Regardless of what type of income. At least that's the way I've read it so far.
Yes, and again, these things could be open to interpretation too. So we are talking about this very early. But see, to me, this is kind of like what we used to have with the personal exemptions. Is there any difference to that, Professor Plum, other than we all got to take a personal exemption prior to 2018?
Well, prior to 2018, we had the personal exemption and the standard deduction, and the two of them combined equal roughly what today's standard deduction is. So this is just another. Now, this $6,000 is not available to everybody. Being 65 is just the first threshold to being able to get this extra $6,000 deduction. If you make more than a certain amount of income, you don't get the deduction. If you're a single individual and you have more than 75,000 of modified adjusted gross income, you lose the ability to take this deduction. It's not an all or nothing. It doesn't just go away at $75,001. It's phased out over a series of quite a bit. If you're at $150,000, it's actually over $100,000 phase out. You're phased out of using this deduction. So you go from 150, you get or less, you get the full 12,000 for a married couple. At 250, you get nothing. You get nothing. You get zero, nothing.
And you'll love it.
And 75,000 goes to 175 for the single individual.
Okay, so there are income
people that make a lot of money don't get that extra deduction.
No, and again, you have to be say age 65 or older, and it's age 65 for the entire for the year. If you turn
you have to turn age 65 during the year.
Yes, during the year. So whether it's January 2nd or December 30th or 1st or 30th, 31st, whatever it is, as long as you turn age 65 during that tax year, you'll be able to take that. So that's that can help people in some ways by increasing that 0% tax bracket.
Now, this is only good for the next 4 years, according to the new law. This one does sunset. So as much as I loved all the ideas that the bracket's becoming permanent, this is not something that became permanent. This is a 4-year deal.
Yeah. That's one of the downsides. I'll leave it at that. But yeah, okay, but you got it now. So we at least know how long it's supposed to last, and it's not going to go away next year. So these are things that I think affect many people, if not most people, certainly people who listen to our podcast. This increased standard deduction, the senior deduction, and then the offsetting of the Social Security. Now, what we don't know, Professor Plum, is if you aren't paying taxes on your Social Security, unless you have found this out in the last 7 or 8 minutes.
Well, I don't think we're going to find this out until the IRS actually writes their interpretation of what was written. I don't think it was written in a way, because I was talking about this with John earlier, in that, do you have to be on Social Security to get this deduction? And nothing that I've seen in the actual written word that I've been able to find says I have to be on Social Security. It just says age 65 or older.
Yeah, and you were always able to take this. Last year, $1,600 per person.
And we still have that. That didn't change.
So I don't see.
We'll see. So this is an evolving thing. Just like when Secure Act passed, and we got the 10-year rule on the IRA beneficiaries, and then the IRS came in and rewrote the 10-year rule a little bit to stay consistent with other factors within IRS law, tax law. There are some of these that could potentially be rewritten or reinterpreted a little bit to stay in line with other parts of tax law, and we'll see how that happens. See how that goes.
Well, we are talking about this now, and things could change, interpretations could change. But at least we wanted to do this. Now, by the time folks are listening to this, it's been a few weeks at least since this all became law. So I don't think anything will have changed at that point. But all right, so we have those things that has to do with the standard deduction and all that stuff. Now, there are a couple of other things that I want to get into here on this particular bill, and that's the above-the-line charitable deduction, which we'll talk about in just a second here, the increase of the state and local tax deduction.
Those are good things.
Yeah, well, they're good things for people, certainly, who can take advantage of them. Now, for those who can't take advantage of them, it doesn't really help, doesn't really hurt. So, those are the people in the middle. Let's talk for just a second about the above-the-line, about the charitable deduction thing and how this relates to people who don't itemize and people who do itemize.
And for seniors, 65 and older, a lot of seniors don't itemize. And because they don't itemize, they don't get to take a charitable donation as a deduction on their taxes. Now, we've been able to get a small above-the-line deduction for the past couple of years, but that's now been expanded to $1,000 per person, basically. So a single individual has what they call an above-the-line deduction, which means it is not an itemized deduction. It is a deduction that goes into calculating your adjusted gross income. Everybody can take it, and you don't need to itemize to do this. And so if you make charitable donations of at least, or any amount, the first $1,000 of those donations for a single tax return become deductible. And it's $2,000 on a joint return. Now, on the other side of that, we've got these new expanded standard deductions, which means that a lot of seniors that may have, thought that they were going to or were deducting, were itemizing, won't itemize anymore because they don't have enough to, go over the 30,000 plus 31,500 plus the 3,200 plus the 12,000 for a married couple. So this way, they at least get some charitable donation availability to them. But it's capped at 1,000 on a single, 2,000 on a joint return. Now, for people who do itemize, who still can itemize, there is a new small detriment. The first 0.5% of your modified adjusted gross income is wiped out from a deductible standpoint. So if I make $100,000, the first $500 of my charitable donations on my itemized deduction form don't count. So if I, gave $1,000 away, only 500 of it's going to be included in the deductible portion. So you have to look at what your modified adjusted gross income is to see whether or not your charitable donations are going to be itemizable. I'm making that word up.
Itemizable. Oh, okay. Now you said modified adjusted gross income in this case. There is a magi for this particular provision.
And I haven't seen the definition of which magi they're using. Most likely it's going to be the traditional magi, which is your typical adjusted gross income plus any tax-free municipal bond interest that you may or may not have on your tax return.
Okay.
They may add a few other things in, but generally that's what we're looking for. So most people, it's their adjusted gross income, which is the total of all the taxable amounts in lines 2 through 10 or so.
A 0.5% floor is not a lot, so it
does hit some things. I mean, if you're making $1 million a year, the first $5,000 isn't deductible.
Yeah, but if you're making $1 million a year and you are charitably inclined, I'm thinking, that's
you're probably given more than $5,000. But
you probably are. So I don't know how much.
I hope you are.
Well, I think so. What I like about this, and again, I'm not saying good or bad. I'm just saying what I like about the charitable thing. I lost my ability to itemize 8 years ago, really, and so I was unable to take the charitable deductions that I used to be able to take. So it made it a little bit, difficult. But, I mean, even if it's $2,000 for a married couple, that's not bad. That's something.
Now, if you do the above the line deduction, you can't itemize. If you itemize, you can't take the above the line deduction.
Yeah, which makes sense, really, because this charitable donation deduction is for people who do not itemize. So
the above the line deduction, the $1,000, $2,000 above the line deduction, is for people who do not itemize.
Now, can you explain just very quickly, because taxes can be something, why an above the line deduction can be more valuable than, say, one below? And what are we talking about? I don't want to keep throwing out these terms for people that may not understand.
Well, we gave a title of modified adjusted gross income earlier. And adjusted gross income is basically all the taxable amounts that show up on the return before you get to reduce it with your standard deduction or your itemized deductions. But when you're calculating certain things, like how much of your benefit, your Social Security benefit, may be subject to taxation, how much of your medical expenses may be deductible. Now, how much of your charitable donations may be deductible below the line. Above the line reduces your adjusted gross income, which reduces your IRMA limit if you're close to that income-related monthly adjustment out for Medicare Part B and D and C. So having an above-the-line deduction helps in other areas of the tax return. It does reduce your income, just like an itemized deduction does, but it helps in other areas of your tax return as well. And a below-the-line deduction, which is typically an itemized deduction, doesn't help with IRMA. It doesn't help with the taxability of Social Security benefits. It doesn't help with the Medicare or the medical deduction on my itemized. It doesn't help in these other areas. Yes, if I'm itemizing, I get to reduce my overall income, but other incomes have already been screwed up by my income being higher. So an above the line deduction, I think, is a better deduction dollar for dollar than an itemized deduction.
It's a more valuable deduction. These are things like your 401k contributions, by the way, are above the line.
They are above. They don't even show up on the tax return. I mean, if I'm making $100,000 wages and I put 10 away in my 401k, traditional 401k, my salary line 2, shows up as $90,000. My 100,000 doesn't show up, and then I get a deduction. It doesn't even show up. It just shows the net number on the tax return.
So above the line is more valuable from a dollar.
It's more better. Above the line is more better.
Mo Better Blues. That's right. So okay, so that's one that I think will help many people who are making charitable donations. So I think that's probably okay. The increase of the state and local tax. It's called SALT. Now this goes back to the Tax Cut
Jobs Act.
TCJA of 2017, 2018, whatever that was. And
it was 2017 that affected the 2018 and later tax returns.
So back then there was a strict, I think it was a $10,000 limit on state and local taxes that you could deduct on your federal return. Is that explain what that is?
Prior to the Tax Cut and Jobs Act, whatever the state tax we paid for the year were deductible, and whatever property taxes on our primary residence and a secondary personal residence, we could add all that up, and that was part of my itemized deductions.
No matter how big it was.
Yeah. So if I'm making $500,000, $100,000, or $1 million a year, and I pay $130,000 to the state of California because they got a very high tax bracket, that $130,000 was a full tax write-off on my federal taxable income. And the Tax Cut Jobs Act said, no, we're not doing that anymore. The combination of your state income tax paid and your property taxes paid, or in states that did not have a state income tax, the sales tax you paid and your property taxes cannot exceed $10,000. Now, for people in a lot of states, their property taxes are close to, if not over, $10,000.
Yeah,
the without no tax even considering states, the state income tax.
The no tax states, especially, I think were hit by that. But yes, go ahead.
And so a lot of people lost, as John mentioned earlier, their ability to itemize. Yes, they had a $300,000 or $400,000 mortgage, but that created $12,000, $13,000, $15,000 in interest that's still deductible, and then $10,000 is all that's available on the state and local tax. That only adds up to $25,000. Most people then didn't have enough charitable donations and/or medical expenses that were allowable to be deducted to get over the standard deduction. So they just took short form instead of what they used to call the long form. So we lost our ability for a lot of people to reduce our income a little bit,
or a lot,
a federal income tax, or a lot, depending upon what you're paying in state income tax and property tax. So this now has, at least for the next 4 years, been increased to $40,000. Now, that won't take it away for everybody because some people will still be over the limit. But that means that a lot of people now have a lot more ability to itemize and ultimately reduce their overall tax burden, federal tax burden. So that's a good thing. Now, it is not for the super wealthy. If your income is over $500,000, you start losing your ability to take that $40,000 deduction, and you work your way back down to the $10,000 deduction.
Yeah. Now that income bit was that prior to the Tax Cut and Jobs Act as well, or was that? I can't remember now.
I'm sorry.
Well, I mean was there ever an income limit on being able to deduct any of the state and local taxes, or is that
nope.
Is it okay?
No,
so that never
this $500,000 limit is brand new.
Okay, good. All right. So that will help certain people. Again, if you're not paying a lot of state and local taxes, and
if you're making $499,999 of adjusted gross income, you can take the full $40,000 deduction.
Well,
once you go over that $500,000, you start losing your ability.
Yeah, exactly.
1%.
It phases in, as you said, so it's not like you're going to lose everything at that point. So the increase of the state and local taxes, I was a little surprised that they did this because this was such a big thing back in the 2017, 2018 tax cut thing. TMJ. No. TMZ, TCJA. Yeah, I'm just kidding.
Tax Cut Jobs Act.
Now, there are a few others that don't affect as many people. I I'll bring it up, but the no tax on tips and no tax on overtime, I don't want to get into that too much because, first of all, I don't know that it affects a lot of the people listening to this podcast. It might, or it might affect their family members. I don't know. But the real reason is, and I'll have you just describe what it does or what it's supposed to do, Professor Plum. But the reason I don't want to get too much into it is because I think there are so many different interpretations and things you got to do and hoops you got to jump through and all this stuff that I don't know what the final interpretation is going to be, and we could wind up being wrong. But can you just mention very quickly what it's supposed to do?
We know that certain numbers are there. We know that the first $25,000 of tips may be deductible if your income is under certain thresholds, 150,000 or so. And so if you make tips and it shows up on your, and now I was reading somebody complaining that it doesn't reduce all the taxes on that 25. You still have to pay Social Security taxes, FICA, or self-employment tax, depending how you're paid on those tips. But it does reduce the federal income tax on those tips. We'll see if states comply with that. We don't know if the states are going to comply with that yet. So up to 25,000 of tips and up to 12,500 of overtime can be used as an above the line deduction from your overall income. And then there's also, if you buy a new car that is assembled primarily in the US, there is the ability to deduct the interest on the financing of said new vehicle.
That's one that I honestly don't know how they're ever going to enforce or not enforce. I just think that's going to be a mess. But
yeah, I'm guessing that there's going to be a form issued by the financing company because they're going to know which cars do and do not qualify for it, and you're going to get a form that you just like you would get your 1098 for your mortgage. You're going to get a 1025. I don't know what they're going to call it.
It's going to call it a 1025 VW. All right. I don't know.
Now, VWs aren't made here. It's going to be
not.
the 1025 Ford.
1025 GMC.
Yeah.
I don't know. Do they still make GMs? I guess they do. Is that still?
Yeah, there's quite a few GMs still out there. They have cut back on the number of brands, but there's still quite a few GM brands out there.
Yeah, so I only bring those up because that was talked about a lot. But honestly, as I said, I just don't think that the interpretations are going to take a long time, and I just see that's going to be some kind of a mess. So, but it is in there. It is in there. And let's see. I don't know. Okay, first of all, there are dozens and dozens and dozens more things in this. We're not going to get into some of the more intricate details of this stuff. And I'm going to say again here, because we're about to wrap this up, but I know we're going to get people who are going to say angrily, you didn't talk about this and it's horrible, or you didn't talk about this and it's the best thing that ever happened. And we're only talking about this because it affects the planning portion. And this is what this podcast is about. Okay, I recognize that, and I said at the beginning, some people are really going to get hurt by this. Others are going to benefit immensely from this. The point of us doing this isn't to bring that stuff up. That's go find your own political podcast or whatever channel you're watching, and you're gonna get all you want. This is strictly to talk about from a planning perspective. And I said it at the top, but I just wanted to make this clear again. This is why we're talking about it. This is not an endorsement. It's not an opposition. It's just, here are the facts. This is what we're going to deal with.
One last fact.
Okay.
If you're planning on buying an EV, electric vehicle, do it before September 30th.
Oh, what? Oh, yeah. Okay, throw that in if you would. I just read that like a day and a half ago. It expired. The credit, right?
The credit for electric vehicles terminates on September 30th. After September 30th, residential clean energy is basically gone now.
Yeah.
A lot of the clean energy credits, the electric vehicle and things of that nature, are being done away with.
Yeah, and that's something that.
But it might be.
I don't know.
If you were looking for something to push you over the edge, you're thinking maybe I want to buy a new vehicle, and I want it to be an electric vehicle. Where if that line was, am I on the fence?
Yeah.
If you needed a reason to push you off, this may be it.
This
Other
may
than
be
that, don't worry about it.
This may be the reason to buy the electric vehicle. Yeah. Well, it's supposed to discourage sales of the electric vehicles. I'm not even going to get into that, but that's something to throw in. You're right.
And if you're having kids this year, you may be able to open a new account for them with some money in it, and can have it grow for 18 years.
Well, and they compare that to then there's the 529, and this does not. The 529, I think, from what I can tell, has better options ultimately. But you know what? Again, here we go with this, because all this stuff could change and be reinterpreted and thrown out. I just,
the difference is the 529s can't be used for a first-time home purchase. They can't be used to start a business, and that's what these accounts are for.
Yeah, but you know what? They got to be 18. It's got to go for. Yeah, so that's way in the future. I mean, from a planning perspective, strictly from a planning perspective, there are opportunities here. I think that we didn't have before, that if you are looking to potentially manage your taxes a little bit more, potentially reduce taxes a little bit more, this is something, these items that we talked about on this podcast, I think are ones that you'd probably need to look into the most. My favorite,
These
I
are
guess,
the ones that are going to affect the most people.
Yeah, well, it is. Now, my favorite is the increased standard deduction and the senior deduction, and I'm not even there yet. But the only thing,
and you know what? By the time you get there,
I know
they're sunsetting.
It is. I'm 4 years away.
They just did it. They're saying, okay, when's Dean turning 65?
Exactly.
We're sunsetting the year before. That works.
They've done that before to me, by the way. They did that in 2017.
All because of you.
All because of me. Well, my hope was that that all Social Security taxes would go away. It can't go away. The bird rule, I get it, and all that, and it has to be a different piece of legislation. But my hope was that everybody,
and that piece of legislation has been introduced. I don't know how much it's catching on, but legislation has been introduced, supposedly through the proper channels, to be able to change this actual law, to take the tax on Social Security away.
Yeah.
Will it happen? Who the heck knows? I didn't think they were going to get rid of the WEP and the GPO, and they got rid of that after talking about it for 20 years. Maybe this bill has some chance. I don't know, but it's a separate bill.
Yeah, separate bill. And we will keep an eye on it, especially as, I get closer to that age. Because it's all about me, Professor Plum. It's all about me. No, I'm kidding. It isn't about me. But this does present planning opportunities. And for those of you who would like to know exactly how this affects you, or what provisions you may be able to take advantage of, or conversely, if it's not going to work in your favor, how can you potentially make things better for yourself? This is your tax planning opportunity. You can call the folks at Lucia Capital Group. Professor Rick Plum, certainly heading up the financial planning department. 800-644-1150, 800-644-1150. And if you want to go get this stuff online, that's what I was going to say. Go online at luciacap.com, LUCIACAP.com. You ever start to say something and you just lose your train of thought? Like, what was my next word going to be?
No, I must not be as old as you are.
Is that only to people who are like 61, not people who are 65 like you? Okay. I don't know. That was an odd thing. Anyway, no, luciacap.com, LUCIACAP.com. You'll find a lot of this stuff. Actually, no, you probably won't find a ton of this stuff up there yet. But you will find stuff on tax management, which is, across the board, that is an important part of planning. So if you want to know about that stuff, go there to luciacap.com. Also, don't forget to subscribe to this podcast. That is a big thing. I should have mentioned that first. Go to Spotify, go to Apple Podcasts, and get every episode downloaded to your device. Very important that you don't miss an episode, because you miss one, you miss a lot. And I know I say that a lot, but it is absolutely true. All this stuff that we mentioned today, you would not have known about that necessarily if you hadn't listened to this podcast. So any final words on this, Professor Plum? I mean, I honestly think this is at least an opportunity for people to look at their financial plan, or if they haven't talked to an advisor, this is a chance to say, what can this do for me potentially, or how can I avoid some of the bad things about it?
Well, this is the law of the land. Whether you like it or don't like it, I don't care. We have to deal with it, and let's use, if they're going to give us something that we can use to our advantage, let's use it. but we have to know what it is before we can use it or not use it to our advantage. Let's study this a little bit. Let's get to know it, and let's use it and make our life as efficient as possible within the guidelines of the rules that they set for us.
Yeah, and we may revisit this in 5-6 months if things become clearer. I imagine we probably will. But at least for now, you've got kind of a head start in this. You know exactly how this can affect you, and that's why we're here for you. All right, that's it. That's all the time we have. Thanks so much for joining us. Hope you enjoyed this one. This is Managing Your Financial Future for Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor. I'm your podcast host, Johnny Dean. Thanks for listening. We will, as always, talk to you again next week. The information provided should not be considered specific, tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Municipal bond interest may be subject to the alternative minimum tax. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Earnings from a 529 college savings plan can grow tax deferred and may be withdrawn free of federal taxes when used for qualified education expenses. Non-qualified withdrawals are subject to a 10% penalty tax. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC.